Bill, can you give us your hypothesis on why you think investors are flocking to some of these large scale players, given where we are in the market?
I think a big part of it is that there's just a bigger universe of $20 billion plus companies than before. In 2013, I think there were 28 companies worth $1 billion or more. And now we probably have 30 or more companies worth over 20 billion. So the overall addressable market has gone up as companies are staying private longer and continuing to grow larger and larger in size. And the second is perhaps in a time of uncertainty, there's a bit of flight to quality, right? Maybe the company I invested in at a $40 billion valuation isn't going to have some 5x or 10x return. But I do believe that if and when that company ends up going public, I am going to do pretty well and my downside is a bit more limited as compared to a wide swath of companies in the $1 to $10 billion valuation range that could be 15-year-old SaaS companies that are still figuring things out, or they could be 3-year-old companies that have just raised quite quickly. Each of those bands of companies introduces some risk. So for us, we think it's a bit of what we'd call flight to quality, even within an inherently risky asset class, is what we're witnessing, alongside the fact that it's just a bigger asset class or bigger addressable market than it used to be.